Hello and welcome to Big Deal. I'm Nisha Poddar, and today on Big Deal, I have a team of experts to really discuss the return of the startup IPOs in the stock markets. A lot has happened over the last few years and many learnings, and whether they can make an entry and in what form. That's what we are going to discuss with the team of experts joining me. Let me welcome on the show Gaurav Sood of Avendus Capital, Amrit Acharya of Zetwerk, and Gautam Patel of Z3 Partners. Now, gentlemen, welcome to CNBC TV18. Gautam is sitting right here with us in the studio. Let me begin with you. Gautam, you've seen several stages of the startup's life cycle. You've seen how the IPOs panned out in the last few years, and 70% of the fundraise done through the IPO was to give an exit to the VCs like yourself. Is the VC community right now worried with the way the valuations have dropped from the IPO figures to now, especially in the equity markets, and the kind of preparedness that we are seeing in terms of valuation expectation of the aspirants?
Yeah, Nisha, thank you for having me on the show. Of course, the VC community is very cautious, concerned right now, given the macro conditions of tech markets across the globe. But more importantly, how some of the startup IPOs have performed in the last 4 to 5 years.
Yes.
So if you see that, they've been down below their IPO prices from 30 to 70%, which is worrying. And there are a lot of irate retail investors out there who are looking for better performance. So my sense is that's one. But the other concern is, for us VCs, is effectively in the next the next 12 to 24 months, with valuations being compressed, we're trying to figure out for some of our better performing companies what's the right timing for that.
Right. So timing is also equally important, and preparedness at the time of really coming to the market. But let me just focus on one summation of the data that we have got on the current price to book value and how it has really dropped from the time of the IPO for most of the companies in the digital space. So we have summed it up and we'll be flashing that on the screens. Now, coming to Gaurav. Gaurav, you've seen many ECM cycles, you've done many IPOs, and now you've joined Avendus, which has been one of the stalwarts in fundraising for stage A, B, C, D for the startups, and now looking at the IPO market and ECM advisory with you at the helm of it. So Gaurav, how do you see what has panned out and the valuation drop? What does this signify for startup IPOs, and what will be your strategy at Avendus now?
Sure. Thank you, Nisha, for having me here. So, obviously we've all seen how the capital markets have performed in the last couple of years, especially 2021, which was the watershed moment for Indian equity markets, especially the tech sector, where we saw 5 or 6 of some of the large tech unicorns come and list and get a phenomenal response from the public market. So clearly, couple of trends that we saw in 21, and those trends we believe will continue not just in 23, 24, but beyond. There are a lot of institutional investors that are believers in these businesses. It is not just that it was a one-time phenomenon. We clearly believe, and at Avendus, we work a lot, as you mentioned, we work a lot with a lot of these companies on the private side. So there is a lot of belief in the ecosystem. We believe that these companies are here to stay, and a lot of them will find acceptability in public markets. Of course, valuations have changed, and things are different from where we were in 21. But that's not just a function of how these companies, not just about the IPOs, but it's also the way markets are. Markets are clearly different from where we were in 21, which was a liquidity-driven environment where issuers were getting top dollar valuations. Of course, things have changed. Today we are in a heightened monetary tightening regime, and with the way interest rate cycles are, obviously valuations have come off. Cost of capital is significantly higher. So we should not, it's not just about tech IPOs. Overall, there is it's a different market. But if you ask me, will there be belief in these companies if more such companies come to the market? The answer is a resounding yes. We have interacted a lot with private companies in the last 6 to 9 months, who are looking to go public maybe in the next 2 or 3 years, or maybe some of them will go public in 5 years. But there is obviously a lot of.
Right, right. So it's a different market. That's coming out loud and clear from what Gaurav is saying. But Amrit, I'll come to you for the toughest question. You are now representing the entire startup founder community. And how do you see this particular situation in terms of valuation drop and the confidence level of the founders to raise funds and give exits to their VC investors?
Yeah, I mean, there are many things that are under a company's control and some that aren't. I mean, I fundamentally think that IPO is less a exit, but more like the beginning of a new journey. It's a milestone in the company's, and depends on the timeline of the company that has its mind. Like for us, we think in decades, and definitely like when we think about an IPO, it will be not. I mean, one part of it is of course, helping out shareholders who have return expectations, but it is also to bring in a new pool of shareholders who can be shareholders in the company for the next 10 years. Right? So, I mean, that's how we would think about it. And of course, pricing is function of many different things, but I think few things that companies can do starting today. I mean, the thing, our biggest takeaway from seeing other companies in the public markets is that public markets really value predictability. How accurately can you forecast your company's performance for the next quarter and the next few quarters, and then how true are you to that performance, that whatever you forecast. And forecasting is a muscle that is needs to be built along with all the other muscles that companies do build over a period of time. I think that's one takeaway we are having, that when we give guidance to our existing shareholders and new shareholders, how good is our guidance and how accurate is how do we live up to that guidance over a period of time?
Right. So, Amrit, the biggest takeaway from what you said is that you are looking at more long-term focused investors, because we have seen in the last cycle that there was a lot of pressure from some of the investors for an exit. So you don't want that kind of a pressure as well. So that's one important takeaway. But, Gautam, this has been a talking point in terms of the valuation, whether we have left enough on the table. While the overall market has dropped, the digital space has significantly underperformed the rest of the market and the age-old blue chip and the well-settled brick and mortar old economy companies. So when we look at this particular comparison, how do you compare the valuations that are trending right now? And I'm not just talking about the public market, but even in the private market, the valuations have dropped significantly.
Yeah, sure, Nisha. So I believe, India is probably one of the most exciting destinations for digital and tech investing today. The question is, we call it a 95 and 5 game.
Yes.
There are 95% of the companies which are suboptimal and 5% which are the greatest companies we're going to see out of this country and globally. The question is that we are coming from a recovery that our companies, our startup IPOs were trading at 30 to 50 times sales.
Yeah.
That's not sustainable, and especially that's only for the market leaders. Now, if you look at the multiples, they've compressed significantly to 5 to 10 times revenue. So effectively, but even if you see the better performing startup IPOs in the last 5 years,
yes,
these guys have performed at 5 to 8,000 crore market cap,
yes,
at 1,000 crore revenue number. So we believe there's a fresh pipeline of good IPO candidates from the startup community at these metrics, which is approximately 5 to 8,000 crore market cap, but at 1,000 crore revenues, with strong unit economics, good governance, and good capital efficiency.
And clear path to profitability, if they are not already profitable.
Exactly. So when I mean strong unit economics leading to either profitability in the next 24 months or already profitable.
Right. So that has really seeped in. Let me ask somebody who's been now speaking and probably pitching and also speaking to the investors. So Gaurav, what do you think? Has the understanding of lower valuations more aligned with the reality really seeped into the minds of the founders and VC community? First, on one hand, and second, how are institutions really, the domestic institutional investors, looking at these IPOs? Once burnt, are they ready to take another bet?
Sure. So, firstly, on the question how the companies are thinking, when we talk to companies, nobody is really talking about what valuation we will get in the market. I think people are more concerned and cognizant that they want a successful IPO. And what they are working towards is getting a high quality, successful IPO done in the market. And for that, issuers today are preparing 2 to 3 years before the IPO. So they are getting processes in place, systems in place, board in order, full management team, which will run the company, not from an IPO process, but even after. Valuation is, most people who are, who've seen the cycles do understand it's a byproduct of not just how the company is, how the business is, strength of management, but a larger function of how the markets are at that point of time. A lot of these companies which listed in 21 were resounding successes. Most of them were 20, 30x subscribed, got phenomenal valuations, but same businesses in this market would not have got those valuations. So issuers are preparing for successful IPOs and life in the aftermarket. They are aware that this is a decision that they cannot go back on life. Once you are listed forever. And they want us to be fully prepared to live life in the aftermarket. Valuations is a function of sentiment at that point of time. So I think people are cognizant that it's not what happened in 21 is a template for the years to come. On your second question on institutional investors, of course, there was a little bit of a, for the lack of a better word, a little bit of a FOMO in 21, and people felt that this is a big tech wave, and everybody sort of participated. I think this time the barriers to come into the market are high. Investors will ask tougher questions, and specifically on things like paths to profitability. In the past, you could have gotten away with an ambiguous answer to that, but now investors are much more specific in those questions. If you're talking about a path to profitability, then the point is whether it's next 4 quarters, 6 quarters, or 8 quarters. So that is one question that will, but otherwise, as my colleagues mentioned, clear, focus is on unit economics and operational efficiency. So investors have clearly put the bar higher than last time. That's something which I would like to share.
All right. So very important takeaway that investors have put the bar very high. But I would say that the valuation is also a mechanism of also calculating based on the last round. And the last round for most of these companies had been done at a very high valuation. So a lot of companies will find it very difficult to either raise funds or give any exits at the current realistic position in the market. And that is becoming a catch-22 situation. On that note, we'll slip into a short breather, give it a little more thought, and we'll come back with more discussion points on this subject on Big Deal. Stay tuned.